Hi eToro, it is Monday the 20th of March, and that means it's time to take a look at what moved the markets last week. The saga that started with US regional banks continued last week with a European bank, Credit Suisse. Within the space of 7 days, we saw the Swiss central bank provide a huge amount of liquidity to Credit Suisse. The seemingly was not enough, and by the end of Sunday, being yesterday, we saw the bank bought by UBS for an enormous discount to the share price that it closed at on Friday last week. Now, to the layperson, a big financial disruption in the US seems to be spreading to Europe, but that's not actually the case. Credit Suisse has not been a very healthy company for a long time now. However, the problem is that the banking system globally is built on trust. All banks around the world are leveraged to some degree. That's how the fractional reserve system works. And if trust in the banking system is completely gone, there is a chance that that panic in of itself can cause otherwise healthy banks to also collapse. This, of course, has created a number of hot takes around the current situation and what might happen next. There are people in several camps that are completely certain that they know exactly what is going to happen with banks around the world and the global financial system. But I don't think that this is a very easy situation to call, particularly in the details of those forecasts. For example, the hot take on screen has a Morgan Stanley strategist saying that this is a sign that we are entering the last phase of the bear market, but that there is a lot of pain in store for investors as part of this final phase. Now, this person might be right, but I think that this is a very difficult thing to call. And since I am not a fortune teller, I'm not going to even try and guess where the current situation eventually lands. But that doesn't mean that I won't follow the developments with a good deal of interest. One very interesting example is the effect on interest rates, particularly in the US and Europe now. On screen I have the yield for the US government 10-year bond, and you can see that the expectations for the interest rate of this period have significantly dropped through the past 2 weeks. This is incredibly ironic, especially since you can see that in the 2 to 3 weeks preceding that, expectations were growing quite rapidly. And now that expectation has entirely been reversed. The reason that the bond market expects that there's going to be a slowdown or even a pause in interest rate hikes is because the rapid rise of interest rates within the US is at least part of the reason that we're seeing the trouble within US regional banks right now. Headlines about banks definitely dominated the media last week, but there were a number of other very interesting developments. So macro data out of the US, the CPI numbers more or less came in as expected. But something that was particularly interesting is that PPI, which is another measure of inflation, came in significantly lower than expected. The reason that I find this so interesting, so CPI is effectively consumer inflation, a rise in prices for things that consumers buy, whereas PPI is a rise in prices for things that producers and manufacturers pay. This means that CPI is a lagging indicator, it tells us what already happened, whereas PPI is a leading indicator. It tells us what will happen, at least with respect to CPI in the future. The reason for this is that if the prices that producers, manufacturers, service companies are paying is dropping, that those drops in prices will eventually be passed through to the consumer too. Something else out of the US that the market has been watching very closely have been jobs numbers, right? So employment, unemployment numbers, and the initial jobless claims that came in on Thursday last week were lower than expected. This is showing us that the jobs market in the US still somehow continues to be incredibly resilient. And if we look at this over a timeline of the past few years, you can see that it has been in a downtrend and is relatively flat right now. The last thing that I wanted to talk about in terms of macro last week was the interest rate decision by the ECB. Now, given the trouble with banks through the past 2 weeks, there was an expectation that the ECB might have taken it easy and changed their mind with regards to hiking by 0.5%. However, on the day we found that the ECB actually did go through with the hike. However, during this event, they also changed their messaging from we're going to keep raising interest rates significantly at a steady pace to we're going to see how the situation unfolds. This is quite a large change in stance for the European Central Bank, and I think that we might see something similar from the Fed later this week. So what else happened last week? Well, there were two companies in my portfolio that reported earnings. One of them was UIPath. UIPath is a software as a service company. They create software that helps you automate business processes across different software that you might use. An example of this is maybe you take orders over the phone. So your customers, they call you over the phone, you enter data in one system, and as part of your business process, you then need to take the output of that first system, put it into another system, a third system, a fourth system, etc. This is a very common way for businesses to operate. UiPath allows you to automate some of that. They have software robots that you configure, and they will handle all of the data entry as a human counterpart would, thereby helping you reduce your cost of business. UiPath is a very young company, and so they tend to be put into that bucket of more speculative tech. Although they have been operating for a while, they're very successful, very good products. They've got customers around the world. They were growing quite rapidly until the current economic situation arrived. And they've also been heavily impacted by the war in Ukraine. The company was started in Eastern Europe, although it later moved its headquarters to the US. That all being said, the share price has been having a rough time. As you can see on this chart here, it's been falling for a long time, and it seems to have been bottoming out through the past few months. And they reported earnings that were much better than expectations. They beat on earnings as well as revenue, but also their forecast was very, very strong. And on the day, you can see that their stock price jumped and ended the day 17.5% up from the previous day's close. The second company I own that reported earnings last week was Volkswagen. Some of you might say Volkswagen, I say Volkswagen. And the market was less happy about the earnings that Volkswagen put out there. There was a bit of a slowdown in terms of the number of vehicles they shipped. However, they did manage to increase their revenue just a little bit, and they are sitting on quite a large pile of cash at the moment. The stock price has been dropping significantly. This is in part because of the earnings report, but also just because of what's been going on out there in the wider economy. For those of you that don't know, Volkswagen actually owns or has a controlling interest in a number of very high-profile brands. Porsche IPO'd last year to a very strong valuation. And if you were to do some back-of-the-napkin mathematics in terms of what you think the market cap of these various companies should be, it's difficult because some of them are private companies, so you don't have access to the financials. But if you were very conservative, you will come up with a market cap for Volkswagen that is significantly north of the market cap of this company today. The reason I keep jumping back to this article is because this person shares some of my opinion. I don't agree with their specific numbers, but I do think that the share price of Volkswagen is probably half of what it should be based on the company today. That's excluding the investments that it's making in things such as EVs and becoming a company that creates its own batteries. So one earnings result that was absolutely fantastic, a company that I plan to hold for a long time. I see it as another CRM, Salesforce kind of company, and it owns a very large chunk of the total addressable market. It is a market leader, and I think it will do well through the next few years. Volkswagen, again, another very strong brand. I am tempted to add a little bit more to my portfolio at these prices because I think 5 years from now we'll be laughing at the current share price. So on to this week. Well, the thing that the market is going to be laser focused on is what the Federal Reserve is going to do about the interest rate going forward. The situation that we have within the US banking system right now means that the behavior of humans will naturally mean tighter financial conditions for at least the next few months. With everyone worried about a potential collapse of the financial system, although I don't think that's on the cards given current information, when businesses and people are very scared about the economic situation within the world, they tend to be more conservative when using their money. And so even if central banks didn't continue increasing interest rates, it is likely that there will be a slowdown in GDP because of this behavior. The trouble with that is it's very difficult to quantify the size and duration of that behavior in the market. So now the Fed finds itself in a very difficult place. Inflation for the past few readings has not been coming down by as much as expected. The rate of the drops in inflation has been slowing down. Initially, the market interpreted this as the Fed was going to continue tightening quite aggressively in order to deal with that situation. But now we're seeing trouble within regional banks within the US because of the size and pace of rate hikes, so there's going to be pressure on the Fed to do something about that too. Long story short, the Fed is caught between a rock and a hard place, and so everyone's very interested in what's going to happen this week when we get the Fed's interest rate decision on Wednesday at 6 p.m. in the UK. We will also see some interesting macro data points out of the US on Thursday, and in the UK we're going to see quite a lot of interesting macro data. So we're going to get that CPI consumer inflation number out of the UK, the interest rate decision from the Bank of England, and we will also get these PMI numbers. So PMIs tend to be a leading indicator on the health of an economy. If the numbers come in 50 or higher, you're usually looking at an economy that is in expansion mode. Lower than that, and it's in contraction mode. On top of this, I also will have 3 companies in my portfolio that will be reporting earnings, but I'll talk more about that next week. All right, hope you have a good one. Speak to you soon. Goodbye.